Started. Welcome to the session. My name is George Aragon from Arizona State University. I'm an associate professor of finance. Thanks to David for inviting me to present some of my research for the last, so just to kind of tell you a little bit about myself. Like I said, I'm an academic researcher for the last 10 years or so. I've been researching hedge fund industry. Got a couple papers on performance, liquidity, different roles of hedge funds as financial intermediaries, and recently I started to look at onshore and offshore hedge funds, in particular the differences in performance, organizational design, and investor capital flows into and out of these two different types of hedge funds. So I think it's a very nice opportunity for me to get some comments and some questions on my research. And what I have planned for the talk is to just discuss the results from this research. So it's an empirical study. I'm going to throw a lot of empirical facts out at you guys. And then I try and make sense of these results, because it turns out we do find, we meaning my co-authors, Hyuna Park and Liang, we do find significant differences in some important economic variables between onshore, and by that I mean U.S. domiciled hedge funds, and offshore hedge funds. That is, hedge funds that are domiciled in low tax jurisdictions like Cayman Islands and BVI. This paper was accepted in the Journal of Management Science. So if you want the complete version, you can find it in that journal. And then after I discuss the results and tell a story to try and rationalize these results, I'm also going to discuss some recent work that I'm doing that's related, that looks at broad trends in the offshore hedge fund industry, in particular trends in market share of different jurisdictions. So I think I found some interesting patterns, and I need some help to try and explain what we're finding here. Okay, so that's how I have set it up. What the paper does, so this is the published paper that I was asked to present, is we look at whether these two groups of hedge funds, onshore and offshore, are similar in three dimensions. First is the performance. So from an investor's point of view, what they care about is what are the after-fee returns to their investment. So is it the case that onshore funds perform the same as offshore funds or not? And then we also look at investor flows. So if from the manager's point of view, if one of my goals is to maximize assets under management, then I would care about these results, because I know, for example, if I set up offshore, to the extent that investors react differently to my performance as compared to if I were domiciled onshore, then that may influence my decision to set up shop in Cayman versus the US. So we're going to look at the investor flows. And lastly, we look at organizational design, okay, because what we have information on are the fees that are paid to these managers, so the performance fee, the management fee. We also have information on the liquidity restrictions on the investors in these funds, so lockups, notice periods, and so on. And we just see whether or not that there are systematic differences in these contractual features between onshore and offshore funds. And like I said at the start, we do find some important differences between these two groups of funds. So here's some info from our sample. This is kind of to show you the coverage that we have. I'm not familiar with how much you know about hedge fund research, but there are the data that's available for academics, okay, is fairly limited, and what we can get are these publicly available databases that are used by hedge fund managers to advertise and attract capital. Okay, so I'm thinking about the Lipper-Tass hedge fund database, Barclay Hedge, Eureka Hedge, HFR, these type of databases. That's the engine of this research agenda. Okay, and so what we have in our sample is from this Tass database is we have over 4,000 hedge funds, more so for offshore than onshore, and the coverage is on the order of 500 billion US dollars. Okay, so this is a significant window into the industry. Okay, and the point of this figure, why we have in the paper is to help motivate looking at offshore and onshore funds differently, because it seems as though not only is the offshore market larger than the onshore market in terms of AUM, but the growth rate seems to be significantly higher. So for example, if you look at 2000, the AUM levels were roughly comparable, but you can see that the offshore AUM really took off, okay, over the last 10 years or so. So that's what kind of drew our attention to looking at whether or not there are differences between these two groups. And when we kind of dig deeper into researching offshore and onshore funds, we begin to learn about the regulatory environments and the differences in the investor tax clienteles between these two groups. And so what we're going to do, what we do here is we kind of focus on two of these differences that we use to help tell a story that tie our results together. And the first key difference that we notice is investor tax clientele. So in particular, onshore funds attract taxable investors, while offshore funds attract tax-exempt investors like endowments, pension funds. And they also attract non-US investors. Now, what does that mean in terms of organizational design, performance, and capital flows? That's going to help us form our hypotheses for our empirical test. That's on the next few slides. But the bottom line is that these differences we attribute to differences in organizational structure. So onshore funds are typically set up as LPs, and that's beneficial for taxable investors because of the pass-through status of partnerships in the US, but it's not beneficial for tax-exempt investors like institutions because of this unrelated business taxable income that is derived from leverage strategies. So if you're a hedge fund, leverage is a big deal. And so for hedge fund investors, if you're tax exempt, this is an important consideration. And so as a result, we might see more of the institutional flows, the tax exempt flows going to offshore. Okay. So we take this as a premise for our empirical test. And the second one that we look at has to do with what onshore funds are doing to keep their status as private funds, meaning avoid registering or avoid being regulated under the Investment Company Act of 1940, which is in the US how we define a hedge fund or a private firm. You're not regulated by the Investment Company Act. And how you're able to achieve that is by one of these two exemptions. So it was either Section 3C or Section 3.7. And to satisfy those exemptions, you need to be careful about how you attract investors. In particular, there's a limit to the number and type of investors. And also there's a limit to the distribution channel. So you can only distribute your shares to accredited investors, a limited number, through a private placement channel. And whereas for offshore funds, to the extent that they're not trying to attract capital from US taxable investors, they're not as worried about satisfying these exemptions, meaning they have more ability to attract capital. They can have more investors as those that form their capital base, and they have more distribution channels. This is important if you want to understand capital flows in this industry, because if you're a fund and you would like more flexibility to attract capital, to raise more money for the same particular fund, then it looks like everything else equal, offshore funds would provide that for you. Okay? Whereas for onshore funds, there are these regulatory constraints that come from being exempt under the Investment Company Act. So this is the second premise that we use to form our hypotheses and explain our empirical findings. Okay, so we have differences in investor tax clienteles and differences on ability to raise capital. Okay, now why is that important? Well, look, tax externalities. Now, if I'm a manager and I have a lot of taxable accounts, one thing that I don't want to do is to generate a lot of capital gains or realize capital gains. I don't want to have to realize a lot of capital gains because then I have to distribute them to my taxable investors. Whereas if I do not have as many taxable accounts, well then I can trade more freely and without as much concerned about cost basis and realizing capital gains. So ex ante, and this is the story that we tell, is that one way that we can manage investor flows so that we can trade more efficiently, tax efficiently, is we can impose restrictions on investors' ability to come in and out. What are those restrictions? Well, in practice, they are lockup periods, they're redemption notice periods, they're the frequency of redemption, frequency of subscription. These are all features that are in the offering documents between the LP and the general partner of the partnership. So what we're arguing is that to minimize these tax externalities for onshore funds, we're going to see a lot more lockups and notice periods. Okay? And this is not because managers want to limit investors' ability to come in and out necessarily. It's through a tax efficiency motive. Okay? So tax efficiencies are going to help explain differences in organizational design like these lockup and redemption notice periods. Second thing is trading cost externalities. So by the same token, we can think about trading the portfolio as being something that investors do not like as much because it generates these transaction costs. Every time I buy a share of stock, I pay a bid and ask spread. And there's also some other costs as well. There's going to be some brokerage commissions that the manager has to pay whenever they turn their portfolio. So the more non-discretionary trading, which is trading without any economic reason except to meet redemptions, that's going to impose a cost on investors. Okay, so that's the second type of externality that we discuss in the paper is this trading cost externality. So one way that we can minimize these trading cost externalities is, again, we can impose lockups and notice periods. Okay, and this is going to be more important for onshore funds because they are fairly limited in their ability to raise capital. So for example, if I'm an onshore manager and I have a lot of withdrawals coming in through a big investor, well, that's going to make me turn the portfolio. If I don't do anything else, if I don't have a lot of cash on hand to meet those redemptions, I have to sell some stock. If I'm a stock trader, I got to sell some bonds. And that's something that I don't want to do necessarily. So what I would like to do as a possible substitute is to raise more capital to replace the outgoing investor. But if it's difficult for me to advertise through these Section 3C and Section 3F exemptions, then I'm less able to do that. And so what we're arguing is that, as a result, managers are going to make it more difficult for investors to come and go. Okay? And that's in the interest of all investors because if I'm an investor that's not wanting to leave, then I'm not as worried that there's going to be these trading cost externalities. So just like the first rationale, we again predict that there's more lockup and notice periods and other types of restrictions among the onshore fund category. And it turns out that that's what we find in the data. Okay. Now, whether that's the explanation that you believe, and it's a different story, but that's an empirical fact, and this is what we use to try and understand those results. Okay, and then the other two reasons why these differences between onshore and offshore funds matter has to do with fund flows and fund performance. If I'm a manager and I have constraints on my ability to distribute my shares, to advertise my shares, then if I perform well, I'm not going to be able to attract as much capital as someone who doesn't have those same restrictions. So if onshore funds really have this handicap compared to offshore managers, then we would expect greater capital chasing performance among offshore groups. So managers can raise more money, advertise their performance as compared to the onshore managers that are not able to attract as much capital for a given level of performance. So our third prediction, is that the flow performance sensitivity is going to be much greater for offshore fund managers. And we attribute that to differences in the ability to distribute capital. Yep. Yeah.
The way I know the universe is the fund, the pile of money, is a partnership. It is in the Cayman Islands. It's registered there. It's not running. There's a U.S. feeder that's a partnership. That's what you're talking about. There's a foreign feeder that's a corporation. You're talking about the feeders, okay? There's no managers in the Cayman Islands.
We have both feeders and non-feeders. So there's...
You found managers in the Cayman Islands?
Yes.
You did?
Yeah.
How many did you find? How many of that?
I'm not sure I have the numbers on that, but in our sample, we do have the master feeders that you described. So there's the same guy. He has an onshore fund and an offshore
I
fund.
understand that, but he's in Greenwich, Connecticut.
Sure. But we also have managers that are...
Managers did go to the Cayman
Did go to the Cayman Islands only.
Islands. Found them on like 2 hits.
I don't know the exact numbers, but they're not dropping our samples.
Because as I understand it, all investors are locked up, not just U.S. ones.
Generally, investors are locked up, but the question is the extent of the lockups, So do you have a 1-year lockup? Do you have a 5-year lockup?
Yeah.
And so what we find in the data is that the onshore guys have the 1-year lockup. Sorry, have the 5-year lockups, whereas the offshore guys have...
The same fund, the foreign feeder is going to have a different...
Yes, exactly. I'll show you some...
You should talk about the feeders.
I have some results that look just at feeders. So just hang on a second. Okay, so flow performance sensitivity we expect will be lower among onshore managers, and that has an implication for performance. So going back to investors, they care about which fund is better to invest in, onshore versus offshore. And what we argue in the paper is that if there is a difference in the ability for managers to attract capital, then that's going to lead to a difference in performance. And the mechanism that we have in mind is decreasing returns to scale. So if I am a manager and I have a couple of good ideas, then as capital comes in, after I report my good performance, I'm going to have less ideas per unit of money that I have to manage. And so that's going to create a draw on performance. Now, for onshore managers, which have, what we're arguing here, a comparative disadvantage of attracting capitals, then the good performance is going to be allowed to persist to a greater extent than the offshore managers, simply because there's less money for the same amount of ideas. Okay? So if that's really a binding constraint, then what we should see is that onshore funds perform better than offshore funds. So let's go check that out in the data. Okay, so our main hypothesis, just to summarize, just what I was just discussing, is that we have a share restriction hypothesis that says onshore funds impose greater share restrictions than their offshore counterparts, even among the master feeder structures. As the illiquidity hypothesis is that due to the transactional cost inefficiencies comparable of onshore funds compared to offshore funds, we should expect to see greater liquidity or more or less illiquidity among the onshore managers compared to their offshore counterparts. Less flow performance sensitivity among onshore compared to offshore, and that is and so as a result of that, is going to be greater performance among onshore fund managers. So our data, briefly, consists of about 3,000 funds, and as we saw from the graph, 60% or so are offshore compared to onshore. And so that breaks down to about 1,700 offshore funds. Our sample period is 94 to 2010. We have monthly return data, monthly AUM figures from this Libertas database. And we have a variety of characteristics for each of the funds: the domicile, lockups, notice periods, manager name, which is what we use to identify master feeder structures for our subsample analysis of that. Here's a slide that is a caveat of hedge fund databases. Like I said, academic researchers don't have much of a window into the hedge fund world aside from these self-reported databases. So as a result, we have to kind of pay attention to potential biases, including, for example, survivorship bias, self-selection bias. You might expect only the more successful managers would choose to advertise to a particular database, and that's what we can observe, right? But for our purposes, what we really don't want to happen, or what we just need not to happen, is for there to be some kind of systematic relationship between these biases and onshore versus offshore choice. Right? So as long as the biases are kind of the same among both groups, then we can kind of feel confident that our results are not biased. Okay, now among the offshore groups, 1710 of those, right? The vast majority are domiciled in the Caymans, followed by the British Virgin Islands, and then the remainder is 287 funds. Okay? And okay, so here's our first test. Okay, take the 1710 offshore funds, all right, and then for each of those funds, let's look at different provisions in the contracts: the lockups, the redemption notice periods, the subscription frequencies, the redemption frequencies, and then compare the average of those numbers to the average of the same number for the 1,200 onshore funds. And so this red box here is telling us that for onshore fund managers, the average lockup is 5.56 months, as compared to only 3 months, 2.8 months for offshore funds. The stars here tell us that it's just statistically significant. So we reject the hypothesis that these two groups of funds have the same organizational structure. It looks like the offshore funds offer much more liquidity to their investors, and we attribute that as being consistent with our share restriction hypothesis. Yeah. By true hedge fund, you mean that? You mean suspicious fund? No. Would you expect a lot of those in these databases? Potentially. Yeah. Well, hang on a second, because we'll talk about master feeder structures. And so if we're worried that there's more of these funny funds in one group versus the other, then when we focus on the master feeder with the same manager, then that should kind of wash out. Right? So if we look at onshore for the same manager versus offshore, then those concerns I don't think would apply as strongly. So just hang on one second. And then, okay, now style by style comparison. So we also know the style category is cut off a bit. Sorry about that. Convertible ARB, dedicated short seller. So we know they're their primary focus. And the bottom line is that this pattern of greater lockups among onshore funds seems to be stable across style categories. It's not driven by just one style category. And the other point that we have from this table is that if you look at the other features, right, besides lockups, there's a redemption notice and so on, we again find a similar pattern. So among onshore guys, the minimum investment size is about $1 million on average compared to 0.8 million among the offshore. Redemption notice, 40 days versus 36 days. This seems to be a pretty strong, robust result. Okay. Master feeder pairs. So this comes to the question about master feeder structures. So how we define master feeder pairs in the data, because we don't have a field that says, okay, this is a master feeder structure. What we have is the name of the management firm and the investment advisor. And we also know the style category for each of the funds, like I showed you from the last slide. So if there's two funds that have the same management firm and same investment advisor, and also the same style category, we call them a master feeder structure. So among the master feeder group, we have a similar breakdown. And there's about 481 onshore versus 420 offshore funds. Right? So it's not 420, 420, twins exactly, because there turns out to be, for example, a couple cases where there's two onshore funds by the same manager, same style, and then there's only one offshore, same manager, same style. Bottom line is we find a similar pattern even among master feeder pairs. So I think it's a pretty strong result, saying that for whatever reason, and we believe we have a reasonable reason, that there's a difference between these lockup and notice periods between onshore and offshore funds. And we restrict our analysis even further, a further refinement for master feeder pairs. So same subsample, but now we drill down more. We say, let's look at the returns on these onshore and offshore pairs, and let's only look at the guys that have 100% correlation in the return. So that's truly a master feeder, same portfolio. And we again find a similar difference between lockup, redemption frequency, subscription frequency. One other thing that we know, if you want to, I know this wasn't part of our main hypothesis, but if you look at the fees among the master feeder, right, it looks as though there's also differences in the fees. So here's the fixed management fee, typically 2%. Incentive fees, typically 20%. It looks as though for the same manager, same strategy, offshore funds have greater incentive fee and also a greater management fee. So we don't have a good story for that. But you would think that if it's the same portfolio, that we would see similar compensation agreements for the same manager. Okay, we do an event study to try and further support our reasoning for why we see these differences. And if you go back a couple slides, part of our reasoning was that onshore funds are somewhat constrained in their ability to attract capital because they care about these exemption requirements from the Investment Company Act, whereas offshore funds don't care as much. So in order to further support that line of reasoning, what we do is we take an event, which is the 2006 hedge fund registration rule in the US, subsequently overturned, right. But what matters for us though, because you're right, but what matters for us though are expectations when this rule was passed initially. Was it perfectly clear when this rule was passed in 2004 that it would be necessarily subsequently overturned? It was passed.
No, passed is what Congress does. It was issued.
It was issued, and as a result, sure.
Was enacted.
Okay, sorry about the terminology, right? But the bottom line is that it created an expectation that hedge fund managers would have to register, right? And empirically, we see a lot of hedge fund registration right after this rule in 2004 was, well, I guess you say it wasn't passed, but whatever it was, there was a deadline that was set before February 2006. Everyone had to register, right?
So that's where you have this strange little short lockup periods. You're just saying it lengthens the lockup periods.
Right. So what I want to see here is whether or not, if this was truly a concern for onshore funds but not offshore funds, then onshore managers would take greater steps to avoid having to register under this rule. There was an exemption, the 2-year lockup. So the question is, when this rule was announced, that by February 2006 they had to register with the SEC, was it the case that onshore fund managers adopted a greater lockup period because the loophole was that if you have a 2-year or more lockup, you did not have to register. All right? And so that's what we do here is we fix a sample of hedge funds and we look at their lockups. We say how many of them had a 2-year or more lockup period. And about 1% of them had for onshore funds, and about 0.5% had it for offshore funds. And as we get closer to the announcement of this rule in 2004, these two are basically the same. So the same proportion of offshore funds and onshore funds had a 2-year or more lockup at the time that this rule was announced. So what we see is that by the time the rule was vacated in February 2006, there was a greater increase in the proportion of onshore funds that adopted a 2-year lockup compared to offshore funds. So we conclude here that this was a concern more for onshore fund managers as compared to offshore fund managers. And further supporting our identification assumption that the exemption requirements are more important for onshore guys and not offshore funds. Okay, a couple of things from this table. So just to summarize so far, we find some pretty robust evidence that if you compare an onshore fund and an offshore fund, the onshore fund has greater lockup notice period, and therefore consistent with our share restriction hypothesis. Our second hypothesis had to do with the degree of asset illiquidity that the fund portfolio has. So is it the case that onshore fund managers hold more illiquid assets compared to offshore funds? We predicted that actually they would be holding more liquid assets compared to their offshore counterparts because of the transactional cost efficiency motives. Okay, it's less easy for an onshore manager to replace outgoing capital with new capital due to these constraints on distribution channels. So we have a couple of measures of asset illiquidity. Right? I mean, it's hard to measure illiquidity. You think about bid-ask spreads, you think about price impact measures. And that's something that we could estimate if we could observe the portfolio holdings of these funds. But we don't have the holdings. So what we do is we use a technique based upon their reported returns. And the idea is that if the returns are more serially correlated, then that is symptomatic of more illiquidity in the fund's portfolio. Okay, and there's a large academic literature supporting that measure, that type of return-based measure for looking inside the fund's portfolio that we actually cannot observe. So the bottom line from this table is that, the bottom line from this table is that if we look at our measure of asset illiquidity, so less liquid assets, for example, bonds versus stocks, the onshore managers have a measure of 0.17. I'm not terribly intuitive what this means, but the offshore manager has a higher level of asset illiquidity. So this is the degree of serial correlation in the fund's portfolio. And the difference is significant, and therefore we argue it's supportive of the overall idea that onshore fund managers hold more liquid assets because of these transactional cost efficiency ideas. Okay, the next thing that we look at, was talking earlier, we have a hypothesis on share restrictions like lockups. We have a hypothesis on asset portfolios, illiquidity. But we also have a hypothesis on investor flows, right? Because the idea was that onshore managers are more constrained in their ability to advertise, so there should be a less sensitivity to performance among the onshore managers. And what we have here is how we calculate flows from this database. Because we can't actually see the dollars coming in and out, but what we do know is the size of the fund every quarter, and we also know the returns. So the difference between assets next period and assets this period can be attributed to either two things, returns or flows. So we do a standard flow calculation to back out the quarterly flows into and out of these hedge funds. And the average flow over our sample period is 2.7% per quarter. Right, so if you go back to figure 1, we see that those upward sloping lines, right? The AUM is growing. So this is simply telling us that on average, the growth rate in capital is about 2.7%. Okay. And for offshore funds, it's about 2.46%. Now, what we care about is the sensitivity of these flows to performance. Because our argument was that because of the restrictions on advertising, onshore fund managers cannot advertise their performance as well as offshore funds. So what we do is we run a standard regression model where we say, can we explain these flows? So we just saw the average flows on the last slide. But what about how these flows actually change from quarter to quarter? Can we explain them in terms of economic quantities? And so we look at performance of the fund. So bottom performance, middle performance, and top performance are the key variables here. They're saying, what's the correlation between performance and flows next quarter? Okay, now if investors are paying attention to performance every quarter and then they're reallocating based upon who's a good manager, who's not a good manager, then there should be a positive correlation between flows and positive correlation between past performance and flows next quarter. So that's what we find. And there's 3 performance variables because what we're doing is we're kind of doing a refinement here. We're saying if you're really doing advertising, then you're probably more inclined to advertise good performance compared to if you're kind of in the lower bin of performance within your style. So the top performance tercile is really the key test of this fund flow hypothesis, because this is when you're doing great, okay? And if you're constraining your ability to tell investors that you're doing great, then the correlation should be lower if you're an onshore manager compared to offshore. So we see 0.285 as positive, so it's telling us that even among onshore guys, if you do great, that attracts more capital. That makes sense. But if you're offshore, it's nearly double, okay? So this is the evidence that we're using to say that the sensitivity of flows to past performance is even stronger among offshore fund managers, and especially when they're performing really well. A difference that we attribute to differences in these requirements on distribution channels and advertising constraints. Okay, so that's and the way you see it graphically, so basically on the x-axis here we have performance last quarter. On the y-axis we have the flows coming in the following quarter. And both of these lines are upward sloping, saying simply that better performance, more flows, okay? But what we want to look at are the differences in how these lines look between onshore and offshore funds. Offshore group is the red line. So what that's saying is, if a manager is kind of in the middle of the pack, okay, average manager, then the predicted flow that we get from being in the middle of the pack is about here, 10% next quarter. But if he were to jump to the top of the pack, right, so 100% rank, then his flows would increase by 5 percentage points if he's an onshore manager. But if he were offshore, he would actually get 21%, so an 11 percentage point increase. So that's the economic impact of this difference in advertising constraints between onshore and offshore funds. It's about 10 percentage points worth of quarterly flows going from the middle of the pack to the best manager. And lastly, we look at performance. So we took a look at share restrictions, asset liquidity, and fund flows. what about the performance, the net of fee returns to investors? Are there differences between onshore and offshore funds? And what we find is, the bottom line here is looking at the average return monthly for onshore funds, 74 basis points. Average return monthly for offshore funds, 63 basis points. And the difference is significant. So it looks like if you just look at average returns, onshore funds have higher average returns to investors as compared to offshore funds. Now, we've got to be a little careful here because this is looking at the full sample period from 94 to 2010. And it could be the case that, going back to the master feeder point, is that the life cycle of a hedge fund manager is you first raise capital onshore, and because you're a new manager and you don't have a lot of capital available, you're able to return a lot of money per dollar, right? Because you have a lot of ideas that haven't been washed away with a lot of capital. So what could be going on here is that these onshore managers are really in the early life cycle of the fund, whereas these offshore funds, if they're the master feeder, they get spun off later in life when the manager is trying to attract more capital and potentially there's fewer dollars per idea to go around. So what might be explaining this difference is not necessarily the structure or the domicile of onshore offshore, but it's just the way the life cycle of the hedge fund manager works. First they're onshore, where they can generate a lot of high returns when they're young, emerging managers. But here it's less so because they're offshore. So what we do is we split the sample into sub-periods. 94 to 2001, that's roughly half of our sample period, and then 2002 to 2008. We lose 2009 and 10 because of the way that we do our tests, but we didn't expect there to be a big difference if we could have extended it to 2010. The bottom line is that for the early part of the sample period, 94 to 2001, that's where we saw the biggest difference between onshore and offshore managers. So now, in the second half of the sample period, there's exactly no difference in net of fee performance to investors between onshore and offshore managers. And we attribute this to the growth in assets managed by these hedge fund managers. And so what we do is to kind of dig deeper at whether or not it's really the case that this is just performance that's being chased away by a lot of money coming into the industry, is we have a graph here that shows the impact of an additional dollar into the fund pot on fund performance. So for example, we have, if we were to hold fix the offshore assets under management at $226 million per fund, and that's the average AUM per fund in our sample, then what we want to look at is how much better do onshore funds perform compared to offshore funds as a function of the onshore size. So when the onshore fund is really, really small, $10 million, the differential between onshore and offshore is very significant. But as we increase the AUM of the onshore fund to meet the average size of the offshore, and that's really where we can compare these two, is when they have the same size, the difference is actually negative. So if you compare an onshore and offshore fund with the same size, it looks as though, if anything, offshore performance is slightly better than onshore performance. Okay, so that's the takeaway here. So it looks like when we ask the question, are there differences in performance between onshore and offshore funds, the answer is it's complicated by the fact that AUM tends to erode performance. So if we were to compare onshore and offshore managers of the same size, it looks like there's very little difference in the performance between these two groups of managers. And we do some more tests to kind of show that pattern is even more robust. Okay. Well, that's the paper that we worked on, and like I said, it's forthcoming in Management Science if you're interested. Here's some work that we're doing now that I look forward to hearing some of your comments. So what we're looking at now are broad trends in fund manager choice of domicile. So we're looking at offshore and onshore funds, taking as given the decision for a manager to set up in an offshore jurisdiction versus the US. What we want to do now is to try and see, are there broad trends in this decision to be offshore versus onshore over our sample period, 94 to 2010? And what are the roles of the bilateral treaty networks in the jurisdictions that they could potentially domicile in For example, the DTC, TIEA, and BIT arrangements. The India-Mauritius example is very poignant because we know that over 40% of the FDI into India comes from Mauritius, and that's been attributed to the double taxation avoidance agreement between India and Mauritius. So we want to know more generally, is this a pattern that we should expect to see in different offshore financial centers? Is it the case that the extent of the treaty networks in a particular jurisdiction are related to growth in the market share of hedge funds in that particular jurisdiction? That's something that we want to look at. And so, we just have some kind of preliminary analysis here. We just have, over time, what we did, we look at the share, the market share of all new funds in a particular year that's set up. So for every fund in our sample, we have the inception date. And there's a couple thousand funds that set up in 1995. And what we're saying is, what proportion of those funds are domiciled in the US, offshore, or in other categories? So by offshore, we mean all the countries on the IMS list of offshore financial centers. And onshore is the US, and offshore are countries like Brazil, mainland Europe, and China, and so on. And what we find is that just generally over our sample periods, that the onshore fund market share is declining steadily. Among the new entrants each year, it looks like fewer of them, as a proportion of all entrants, are actually domiciled onshore. Whereas the other category, and this is, I'm just kind of casually looking at the data, this seems to be driven mainly by Brazil. There's a steady increase in the proportion or the share of all hedge funds that are domiciled in the other category. And like I said, that's mainly driven by Brazil and some other European, and some European countries like France, Germany, and Italy. But what seems to be more stable is the offshore category. So it looks like the market share of offshore jurisdictions of all new entrants seems to be fairly stable over this, this 16-year period. So digging deeper, though, we look at something which is, if we just focus on the offshore line, right, which was pretty flat. What we're doing here is we're saying, what about the concentration of the different offshore financial centers? Okay, is it the case that just one offshore financial center is dominating all this offshore business? Like, for example, Cayman Islands, we know, is the greatest in terms of market share. So we have a measure of industry concentration called the Herfindahl Index. And so it's basically higher numbers means more concentration. So the extreme case, there's only one OFC that has all the business. This number would be 1. But the bottom, when it was kind of all OFCs have just 1 over n of the business, that's basically 0. So what we're finding is that actually, even though the offshore market share in total is fairly stable, the degree of concentration is actually changing a lot. Okay, and in particular, it looks as though the break point seems to be 2007, 2008. So before the financial crisis, there was an increase in concentration in the offshore industry, such that by the Department of Justice classification system, it's highly concentrated. And then now, in present day, it seems to be moderately concentrated. So who are the gainers and who are the not gainers? And so what we look at is increases in, who's increasing market share, right? Since 2007 and 2012. Sorry? So consistent with that, thank you very much. Consistent with that, Luxembourg is number 3, Malta number 1, Ireland number 2. Other side, okay, and so just kind of focusing on those 3 over time. This is just the market share of those 3 countries in the offshore industry over time. Obviously, by construction, there's going to be a positive increase between 2007 and 2012. This is just showing you back even further that even before 2007, it looks like there was an increase in other jurisdictions, except for Malta seems to have taken off. And when was that rule? But even before then, right? There seems to have been a trend upwards. So maybe there's some expectation of the rule. So that's consistent with this plot. Thank you. Who are the decreases? Well, among the decreases in share, clearly Cayman Islands by 18% drop in the total hedge fund market share among the new entrants. Okay, so right now, clearly Cayman is still the largest in terms of all funds that were set up over our sample period. But just from comparing the new entrants in 2007 to new entrants in 2012, the drop is largest for Cayman, 18%, followed by BVI and followed by Bermuda. And if you plot for the top three again, but now the decreases in market share over time, BVI and Bermuda decline seems to have been pretty steady, unrelated to EU directives or the financial crisis. But Cayman seems to have a different pattern. So it looks like, whereas these two jurisdictions had a steady decrease over their sample period, for Cayman, it was actually going the other way, an increase. And then over the last 5 years, from 2007, we see the big drop, the 18 percentage point decrease. This is something that I have no idea about. I mean, this is something that I would appreciate your comments on if possible. Why is it the case that we see this change for Cayman leading up to the crisis, an increase, and then afterwards, there seems to be a decrease? Okay, and then trying to link this to the treaty networks, we took some data from the OECD, and I mean, what we find is that in 2007, Cayman, BVI, Bermuda, very few TIEA, DTA agreements, but these, what we call the winners of the last 5 years, seems to have a very well-developed set of tax treaty networks already. And then in 2012, we see that not much has changed for the Luxembourg, Ireland, and Malta, but I mean, all throughout the last 2 days, we've been hearing how there's more TIAs being signed by Caribbean jurisdictions. Consistent with that pattern, we see that there is this increase in TIAs for these other countries. And yeah, and so I know that there's this kind of white list, gray list rationale. And so I wonder whether that could potentially help explain the patterns that we saw regarding Cayman, BVI, and Bermuda. Anyway, that's all I had to present. So just to summarize, so the takeaway from our paper, hopefully, is that hedge fund managers use financial and investment policy to achieve greater transactional efficiency, both in terms of their taxes, but also their trading costs. And restrictions on fund marketing doesn't seem to have had a long-run cost to managers, because even though capital is not chasing performance as aggressively among the onshore group, it's not that this is leading to some sort of persistence in performance among the onshore managers, which is symptomatic of a sharing of rents between managers and investors. So that's the sense in which we say there doesn't seem to have been a long-run cost, because there doesn't seem to be any difference in performance between onshore and offshore managers. The regulation of onshore and offshore funds should consider the impact on fund investor liquidity and asset liquidity, because we do find differences in lockups and notice periods, and also measures of asset liquidity. And the choice of hedge fund domicile, like I said, is something that we're looking at now. Seems to be an interesting avenue for future research, and something that I look forward to presenting on later. Okay, well, that's all I had to say. Are there any more questions, comments? Yeah. So the onshore had more liquid assets. Yeah, sorry. Yeah.
But how many people are going to those outside the offshore? How do you explain that?
So we start with one explanation that we give in the paper is that there's just some tax reasons why offshore structures are more attractive for institutional investors, because of the UBTI concerns for limited partnerships. Any more comments? Or okay, well, thanks for listening, and I'll see you guys later.